everyone, welcome back to the channel. Today I'm going to take a minute to explain what's been going on in the market this week. The S&P 500 closed around 5350 on Friday to open on Monday as low as 5150, or about a 4% drop over the weekend. And that fared a lot better than some other markets. The Japan Nikkei plunged 12%, its largest drop since 1987. And as of market close on Tuesday though, the market has almost recovered, with the S&P closing up at 5250 and the Japanese market closing at 35,100, which is pretty close to last Friday around 36,000, so not fully recovered. But what's been going on? The Japanese carry trade has been going on. If you're not familiar with the carry trade, let me explain. First, a trader will borrow money in a currency that has a low interest rate. They then convert this money into another currency, and then they invest this converted money at a higher rate than what was originally borrowed. If interest rates were static and did not fluctuate, this would give the ability to arbitrage interest rates and make essentially risk-free money, assuming whatever you invest in was a low-risk investment like a treasury that was yielding higher than your borrowing costs. With a trade like this, there are three main ways you can end up losing money. First, the interest rate goes up on the currency that you are borrowing, thus making your borrowing costs higher. This could either reduce your profits or completely eliminate them, depending on how high it goes. Second, the currency you converted to has the yield drop. If you convert to USD and then buy treasuries and the interest rates are cut, then you would reduce your yield. And this would either reduce your profits or completely eliminate them, depending on the magnitude of the rate reduction. And third, the rate between the two currencies goes down. In other words, the currency you originally borrowed is strengthening and now worth more of the currency that you converted to. So if before you were exchanging at a 1-to-1 and now it's 1-to-2, your new investment just lost half its value, as it takes twice as much of it to convert back to the original currency. That is a very extreme example that you probably wouldn't see unless if there's large swings in interest rates due to a war or something similar breaking out. Think Russia a few years ago. So now an example of how this trade works and what has been happening in the market. If you're a hedge fund and borrow 1 million yen at a rate of minus 0.1%, this would have converted to 6,200 USD at a spot rate of 0.0062 yen to USD at the start of July. Now you go buy a 1-year treasury yielding 5.1%, and you will collect the difference. And assuming there's no changes to interest rates, exchange rates, then that would be around $322 per year. Now, if you're a hedge fund, you'll leverage up as most hedge funds do, and you will try to minimize any changes in rates and exchange rates through hedging, but you could probably borrow basically as much money as you want and collect a free 5.2%, which is the difference between the 5.1% USD yield and the negative 0.1% in Japan. You don't deploy any actual capital as you borrow all of the original money for this investment, and you pay it back, but you're still yielding more than the interest. So it's like a free money glitch in theory. So now let's go through this example and show what could go wrong. First, we talked about the interest rates going up. At the beginning of July, the rate in Japan was negative 0.1%. Today, the rate is positive 0.25%, so it has increased 0.35% or 35 basis points. This impact would have on the trade is your yield will now decrease. Before, we were yielding 5.2% on our $6,200. Now we will yield 4.85%. So it's not a huge deal. Your trade is still profitable, yielding $300 instead of $322. The next risk we talked about was the exchange rate going up. The exchange rate has increased from 0.0062 all the way to 0.0069 in the last month alone. What does this do to the trade? Is now your 1 million of borrowed yen is actually worth $6,900 USD, and you only have $6,200 from when you originally converted it. Even with your interest rate arbitrage, you're only making back about $322. So you would only have $6,522 and you would be short almost $400. This killed your trade. Luckily, rates in Japan have been dropping and we're closer to today's rates at the beginning of the year. So for some hedge funds that have been in this position a lot longer, this may not be a huge factor, but as rates drop, you can guarantee funds borrowed more to take advantage. And now onto the third issue we talked about, which was the yield dropping in the currency that you converted to. In the US, the yield on a 1-year treasury has dropped from 5.1% at the start of July to 4.33% when this all started to unwind. On your trade, if you assume nothing else happened, your yield would have gone from 5.2% down to 4.43%. If this was the only thing changing, this would have changed your payout from $322 to $268. So it wouldn't have killed your trade, just reduced the profitability. Now, the problem here is all three of these things happened at the exact same time. So we had the Japanese interest rate increasing from negative 0.1% to positive 0.25%. The exchange rate increased from 0.0062 to 0.0069. And the US Treasury yield dropped from 5.1 to 4.34%. So with all of these, you now owe back 1 million yen, which at the updated exchange rate would be $6,900 USD. Your yield would have dropped from 5.2% to 4.09%. You would only be yielding $253. If you take your original $6,200 that you converted and we add in the $253 from the interest rate arbitrage, it would give us a total of $6,453. This is short $447 from the $6,900 that we owe. So what we thought was free money is now costing us 7% based on the size of the original position. Now, this isn't a big deal if you're playing with small amounts of money, but let's be real. There were over 180,000 of these carry contracts out there per the Wall Street Journal with a value of $14 billion. By holding this trade, hedge funds were losing $980 million. You can bet you're going to unwind this very fast, and in that process, you will be selling a lot of assets to pay back the original debt. All the rush to liquidate and cover is what has caused the market fluctuation and large sell-offs. Anyways, that's all I had for today. I hope you found this interesting and insightful. Leave any questions or comments below, and thanks so much for watching.